Hi, everyone. We want to thank you so much for joining tonight. Our webinar is called From Reports to Reality: How Reserve and Engineering Studies Affect Loans, Home Values, and Association Stability. Our aim tonight is to make reserve studies and capital funding less mystifying, and to give you practical, actionable information that your board can use. We know that you, as board members, are volunteers and are already contributing a great deal of time to your communities. I'm Kat Danaher, Director of Admin and Marketing at TNWLC, also known as the New Washington Land Company. For more than 41 years, we've been providing comprehensive property management services for condominiums, co-ops, and HOAs throughout DC. Our goal is to help your community truly thrive and to give you back a little of your free time as board members. Let me introduce you to our pros. Michelle Baldry is a VP and Regional Executive Director for Reserve Advisors, the nation's leading reserve study provider. She's been with Reserve Advisors for 15 years and is a certified reserve specialist, professional reserve analyst, and a licensed professional engineer. Jessica Marvel, coming up after her, is a VP and National HOA and Property Management Lending Team Lead for Bank United. She has over 15 years of experience in the industry, including 8 years managing community associations. Now she leads Bank United's efforts, helping associations nationwide find financing for capital improvement loans. Here's our agenda for the next hour. Michelle is first up, followed by a break for Q&A. Then she'll hand off to Jessica, followed again by some Q&A and final discussion. Two important notes for this webinar. All attendees will remain muted for the duration, but we would love to see any questions you have pop up in the Zoom chat. We'll use the Q&A breaks to answer as many as we can. So we truly encourage you to submit any questions or thoughts you've got. Number two, this webinar is being recorded and a link will be shared this week. So there's no need to scramble for screenshots or to take exhaustive notes. Okay, great. Let's get started. Michelle?
Thank you so much. I really appreciate the introduction, and I'm looking forward to have a conversation about reserves and reserve studies. So please, 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 if any questions come to mind, please certainly drop them in the chat. We want to make sure we've carved out some time. I want to make sure that we address any questions that come up along the way. So building a financial foundation, reserves and capital planning and reserve studies have become quite the hot topic recently. And this really relates to the role of the board. This was taken right to from the Community Associations Institute Board Member Toolkit. This quote is a great summary of the role of a board member. The role is to protect and increase property value, which is accomplished by operating the association, maintaining the common property, and enforcing governing documents. Huge, huge, huge responsibility. I know you all are volunteers and it's sometimes a thankless job, and really appreciate all the efforts you do to maintain your community. And a reserve study is really intended to be a tool to support you in that. So how does it support you? The board really has a fiduciary duty, right? You have a duty of care to make informed decisions on how to spend the association's money, act in a prudent and reasonable manner, and make sound business judgments. The duty of loyalty, you want to act fairly and in good faith, act in the best interest and the benefit of the community, and avoid conflicts of interest. And then the duty to act, right? Perform the duties that you need to do and act within the scope of authority. So a reserve study is really intended to be that third party opinion of the community's needs, right? Based on the age, what needs do they have? This provides that information, independent third party, so you're acting fairly, and it's a tool to help you make those informed decisions. So the purpose of the reserve study really is that budgeting tool. It's going to outline all of your community's needs. It's going to help you prioritize your projects and really provide that roadmap, right? What are our key items? What do we need to focus on the next 2, 3, 5 years? But what really should we also be thinking about long term, right? Let's focus on the near term projects, but let's make sure we're accounting for everything. And this is that roadmap to help you do that. I like to describe it, if you kind of consider your annual wellness visit, right? You'd go to your general practitioner to get that overview of how you're performing, right? How is your body doing? How are you doing health-wise? The reserve study is that. It's a visual, non-invasive check on your entire property. And then when you get to a certain age and you need some more kind of invasive inspections, right? Maybe you start seeing certain specialists for certain needs, or maybe you're just prone to certain things. The way your building was constructed, it's prone to certain things. You start getting some more of those invasive tests. Maybe you go to a cardiologist for your heart. Maybe you're working with a plumbing specialist for the plumbing of your building. And then that works into the overall kind of wellness, right? Wellness of your body or wellness of your community, wellness of your building needs. So the reserve study is intended really to help outline all of these projects and give you a roadmap to work off of. Now, I always like to tell everyone, full disclosure, it is not a crystal ball, right? When you're looking at everything, jack of all trades, visual, non-invasive, it's not going to be an exact scope of work for every single project. It's intended to get all of these projects on your radar and kind of refined. So I think that's something certainly to keep in mind. So when the reserve study outlines the needs of your property, it's also going to provide a funding recommendation, right? So how much should we contribute to that reserve account? Essentially a savings account, right? To pull from when you need to conduct these various projects. So that's the intent of the reserve study, is if you want to fund the reserve account as you're kind of using these components. So the homeowners that are benefiting from the roof, or using the lobby or the parking areas, the garage, the plumbing, they're contributing to this savings account or reserve accounts, right? So it's built right into the budget. You pay for things over time, kind of as you're using them. And it's a way to stabilize the budget, because ideally you're just equally contributing as the needs are there. And it's really the fairest way to do that. Now, if you elect not to fund reserves and you don't follow the reserve study, the projects are still going to need to be done, right? The roof will still fail, the pipes will still fail. So the alternative options are either a special assessment or a bank loan, right? And so these typically happen when you haven't been following reserves or you have some unexpected surprise, right? Maybe there are parts for a certain component, your HVAC system became obsolete and you now need to repair it or replace it ahead of schedule, right? So it was an unanticipated expenditure. Usually then you are forced into some sort of special assessment or a loan, which we'll talk through both of those. The benefit of reserves for the board is that it's helping fulfill your fiduciary duty, right? You have this duty to take care of the community, spend the money wisely, and this provides you that kind of roadmap. And then if you're following it, you're kind of checking that box, right? Satisfying the fiduciary duty. It'll also kind of help get some of these projects on your radar. So if you need to start anticipating your roof failing, right? Maybe it's 15 years old, you haven't had any leaks, but we're starting to see some things that maybe this should get on your radar, right? So we're going to make this kind of a priority for you where it's not an immediate, you don't have to kind of react right away and jump on it. You're not stuck with an emergency repair. You have a little bit of time to start planning that replacement project. And it's also really proper stewardship, right? You're maintaining the community, creates this harmony within the community and the building. So what is the importance of reserves to the owner? Why does the average homeowner care? This essentially is protecting their investment, right? Their homes are typically your biggest investment. And by contributing to reserves, it's helping preserve the appearance, reducing maintenance costs. We find that when associations have the funds available and these needs come, they spend it, right? They conduct those repairs or these prevent, like when they know things are starting to fail, we can do it ahead of schedule instead of letting it continue to deteriorate and trying to figure out how we're going to get the money together to do it, right? So being able to kind of proactively plan these projects instead of having to reactionary kind of do these emergency type repairs. And there's also a lot of people looking at reserves now, and this really stems from protecting the investment, right? So mortgage financing, they're starting to look at reserves and reserve studies and structural integrity a lot closer now because they don't want to potentially issue homeowners or buyers a loan on something where they might default, incur some sort of special assessment, or absolute worst case, which we hope will never happen again, a situation like Surfside. So there's a lot of people looking at reserves and reserve studies, from banks to insurance agents and brokers and carriers, a lot more eyes on it, really, and it stems from wanting to protect the investment. So the reserve study, what this really is that community roadmap, right? So we're going to cover the main two portions of it. Of course, there's an executive summary, and there's typically a narrative section that provides this condition assessment, so you have an understanding of the condition of your various components. But really the two main portions are that expenditure plan, what are the needs of the building, and then what's the funding plan? How are we going to pay for those projects? So expenditure plan, this will look different depending on who prepares your reserve study. So I do encourage you to compare sample reports as you're engaging in a reserve study or considering a reserve study, just to ensure that you're comfortable with the format and that you're able to use it and leverage it, right? Absolute worst case, you spend all this money on the study that doesn't make sense to you and you can't comprehend it or don't know how to implement it. So I encourage you to review a sample report and certainly meet with the company ahead of time if you have any questions, just to make sure you're aligned on the scope of work and what the report or kind of output will look like. But for the most part, any expenditure plan will of course have an inventory, right? What are the common area components that the association is responsible for? What's the quantity? So what is the size of the roof? How many squares? What's the square footage of concrete? What's the square yardage of carpet? How many light fixtures are there? Everything will be quantified. Based on the materials, every component should have a typical useful life. And I like to say typical because it's an average useful life based on the materials that were used and the location of the element, right? So a modified bitumen roof in this area typically lasts 15 to 20 years, as an example. Now, the remaining useful life or the replacement timing, that is determined by the condition of the component. So while the estimated useful life is helpful, really what the reserve specialist is focused on or should be focused on is that condition, because you could have a roof that's only 7 years old and in terrible condition, right? We're not going to show replacement of that at the useful life, typical useful life, because that's not what we anticipate. Or you could have an 18-year roof that you've maintained very well, And we actually think you're going to get another 5 years out of it. We're going to show it beyond that typical useful life based on the condition that is observed. Of course, every component is going to have a price, and then the price is going to be inflated over time. So if something costs $80,000 today and we think you need to do it in 5 years, we will apply inflation so that that's taken into account as well. So all of the needs of the building are looked at based on the inspection, so that physical evaluation of the community. And then the next step really is that funding plan. How are we going to pay for it? So a reserve study is snapshot in time. You're going to tell us how much money you have in the bank today. And then we're going to forecast out or provide recommendations on that ideal reserve contribution to offset those expenditures, right? So in this example, this association was slightly underfunded. They were contributing $92,000 and we ramped them up over a period of a few years, looks like through 2030, right? To help kind of incrementally get them where they need to be. And then it's just inflationary increases. So there are different funding strategies. So I encourage you, as you're comparing reports and how you want to conduct your reserve study, something to consider is the different funding strategies. This is an example. It's the same. This is the same expenditure plan, and it's layered in with 3 different funding recommendations. So the baseline funding essentially is the most aggressive, highest risk, and it's bringing reserves right to zero. The opposite end of the spectrum is the fully funding reserve, where you are funding for equal usage of every single component, right? It's actually pretty conservative and results in a much higher recommendation, as you can see. And then what I kind of call the Goldilocks funding methodology is the threshold, where we don't want to go right to zero, but we don't want you to have a surplus of cash just sitting there because we know everything won't fail at the same time. So we're developing a threshold or contingency for that reserve account. So certainly something to make sure that you understand. If you have a reserve study and you have any questions on the funding methodology, I encourage you to reach out to the reserve specialist that prepared it. We are more than happy to meet with you and explain the funding strategy. I can tell you personally at Reserve Advisors, we only show that threshold. The fully funded is pretty scary. It's a big number and ultra conservative. So we actually don't show that. We certainly can if you want to, but I encourage you to make sure that you understand the funding methodology that your association is following. This is a graph of a funding plan. It truly is the cash flow threshold method here, where it's money in, money out, right? So I always encourage associations and boards to share something like this at the annual meeting, especially if you're going to have increases. What this is the blue line is the reserve balance, the green bars are the reserve contributions, and the red bars are the expenditures. So this association has $600,000 in the bank. So it's easy for a homeowner to say, why are we still contributing to this reserve account? We're looking around, things look pretty good. Why do we need to keep contributing? And they're right, for the first few years, you're contributing more than you're spending, you're growing that reserve account. But in just a few short years, you're draining that reserve account, right? You're spending way more than you're contributing and utilizing those reserve funds, which is great. That's the intent of reserves. We don't want you to have all this money sitting in the bank for something that may or may not happen. The intent is to spend it, right? But it's important to understand the long-term strategy. It's not just getting through these initial few years. We're going to need to replenish that reserve account because out in 2043, we need to do another round of very big projects. So of course, this is customized based on your community's needs. There's not a one size fits all. Every community is different. And I encourage you, you guys don't have to be experts in everything, right? Hire consultants as part of our reserve study engagement. We're happy to present this, whether it's to the board at an annual meeting. Let us help you walk the homeowners through the financial situation and ultimately align on that strategy. So what if reserves aren't enough, right? What if you have underfunded reserves, you didn't do a reserve study in the past, or you have done one but didn't follow it? What are our options? Well, a special assessment, loans and financing, and then absolute worst case, doing nothing, right? Just being paralyzed and afraid to spend any money. That is going to cost way more money in the long run as things further deteriorate, more damage occurs, and it's just going to cost more in the long run. So really the two best methods, if you don't have reserves, are special assessments and loans and financing. So special assessments, just a couple, things here to consider with those. In short, important to check your documents, right? Make sure that you understand how you can levy these if you can. There are going to be some administrative fees, collections, and delinquent payments associated with that. So that's a hurdle you're going to have to overcome. Really important to communicate this early, right? Have whether it's a reserve study done and that like we come and explain everything, or your attorney or a bank, like work with your professionals so we can help the homeowners understand the needs of the building. This is good for unexpected expenses, right? If you need to, it's kind of that emergency draw, but not something you'd want to plan on doing regularly, right? It's not a good business practice, not satisfying that fiduciary duty if you're planning to regularly special assess. These repeat assessments really can impact the property values. I'm not going to spend any time on loans because we have the best expert to speak to about those. So I'll wrap here, just quick summary. There really isn't a one size fits all approach to funding. You need to make sure that the reserve specialist understands your needs. We're going to provide our expertise on needs of the building, but we want to create that alignment through collaboration, just to make sure we're all on the same page with the needs of the property, and then determine that funding recommendation. But it really is unique to each association. And the reserve study really is intended to be a starting point, right? It's that roadmap, it's a capital planning tool, but we know there will be changes along the way. We provide a workable file. We provide the Excel file to help you keep things current and start to consider deviations or changes from it, the impacts of that, right? So maybe the reserve study says contribute 80,000, you want to contribute 65. You have a file to kind of play with that and see the impacts of it. But regardless if you fund it or not, it's really important to update these regularly. It's a 30-year plan. Community Associations Institute now recommends updating every 3 years because there's just so many moving pieces, whether it's inflation, weather impacting the condition of components. It's really important to have that kind of holistic site visit condition assessment done every 3 years so you have an updated roadmap to work off of.
Okay, great. Thank you so much. We've gotten lots of positive feedback. We've got a couple of questions. Looks like you've already answered at least one of them. One question that we had from Kathy, how is the value of a component computed?
Great question. And let's just say an average, like a roof, there's a variety of things we look at. So we'll look at the location of the property, what are replacement costs in DC, for example. That's going to be different to replace a roof here versus in Florida. What are the materials that are used? What does mobilization look like, right? How difficult is it to access your roof? Do you have a bunch of mechanical equipment on your roof? The size of the project, that'll play into it. So there's a lot of factors that will play into these replacement costs. So we do the very best we can to estimate them and take all of these sort of things into consideration. However, it's not an exact science. So I want to be very transparent about that. I don't claim that we get it within 1% of, all replacement costs. I mean, I'm sure you've experienced it, right? If you've gone out to bid for a project and you get 3 quotes, there's usually a decent spread between them, right? So while we do the best we can to estimate it and take those sort of factors into account, I'll be very transparent that it's not a crystal ball.
Awesome. Thank you so much. We've got another question from Rebecca. This looks like a pretty intricate question. What is the relationship between the reserve study and the tax treatment of the reserve funds and expenditures? Is this something that would be easy to address now?
Well, I'd recommend working with your accountant to make
Yeah.
sure that, the taxes, it's my understanding associations can operate in a couple different ways. This is beyond my area of expertise, but I think this relates to sometimes there is concern that certain projects like painting, for example, are considered more operational and not able to be funded out of reserves for tax purposes. And that shouldn't be the case. It's a huge project and it is to maintain the longevity of the building. And so I would just recommend working with an accountant to make sure that that's, everything's in line with your accounting principles.
Awesome. Great. Thank you so much. Looks like, can you talk more about one, how to choose a company to do a reserve study, and two, whether there are any assurances provided along with the reserve report, like about any of the estimates made on the life of appliances, et cetera?
Yeah, great question. I would say the best way to choose the company is kind of a variety of things. Your community managers work, I really lean into working with community managers who have direct experience working with different providers, right? They can speak to things that they like and don't like or experiences that they've had. It's a pretty independent third party opinion, right? That being said, other references, the amount of work they do in the area, like are they local to DC? Do they specialize in reserve studies or is this a side business for them, right? And what are the deliverables? So do you get a workable file? I think that's important and becoming really commonplace to give some sort of workable file. What level of engagement is welcome and encouraged, right? Or does the engagement allow for question and answer responses, coordination, meetings, presentations, or is that going to be billed hourly? And then lastly, what does that deliverable look like? Does the report make sense? Is it easy for you to follow? Do you find the recommendations to be helpful, or is it where you're going to spend more time trying to dissect or understand this thing than it's worth, right? It might be $500 more, but if you can easily read it and digest it and implement it, I think it's worth its weight in gold.
Thank you so much. And we had a quick follow-up question on that, which is just clarification of what you mean by a workable file.
Sure. So the reserve study used to be, this binder that would come in the mail. And then we moved to a fancy PDF where you'd get an electronic copy of the reserve study. And now most will give some sort of file, whether it's Excel, we give an Excel file, or some will have portals and platforms and things like that to where you can explore alternate scenarios. So the Excel file, the report is a static document. The narrative that we're going to provide, the photographs, the preventative maintenance recommendations, all of that is still a standard PDF, but we'll provide an Excel so you can move timing around on the expenditure plan, move costs around, and then that flows right over into the funding plan. So it's like a tab for expenditures, tab for funding, and you can see the effects of that, like what it does to your funding.
Wow, that's amazing. It's nice to know that it's not just a static document like that because goodness knows things can change, priorities can change, urgency can change over the course of 3 years or more.
Absolutely right.
Awesome.
Just on that real quick, sorry. There
Yeah.
is, so most reserve studies will include a revisionary period. That's another thing to check. The reserve study, ideally, the specialist is meeting with management and potentially the board up front to create that alignment. Let's discuss the priorities. What are your needs? Let's reflect that in the reserve study. But after reviewing it, maybe the board decides, well, there's a lot of needs we didn't realize. Let's defer some of the more discretionary things. I'd like to move the carpet or, change some timing on light fixtures, that sort of thing. So every reserve study should have a revisionary period where you can contribute and make requests for recommendations. So that's something to check. And the Excel file is actually helpful for that process too. You can kind of play
Sure.
with it on your end, tinker with it before kind of finalizing it. But then you get the other Excel file, because as we know, between now and when you update again in 3 years, things will change.
Sure thing. Awesome. That's super helpful. We also just had a quick question that was kind of a clarification, I think, between what is an engineering study as opposed to a reserve study.
An engineering study could potentially be maybe a study done by a specialist. Like it could be maybe you had an engineering study done on the structure, like a structural engineering study, or maybe it's a MEP, like a pipe study or mechanical study. But my guess is that an engineering study refers to a more specific component and being analyzed by an engineer.
Okay, great. And I think we'll take our final question for this section and then we'll hand over to Jessica. Is an APRA certification or other kind of certification important when considering the company?
So that's the Association of Professional Reserve Analysts. So it is an organization just for reserve study providers. So it's kind of a niche organization.
Yeah.
We think it's important. We helped found it years ago when it was founded. But I would say CAI is probably most commonly known. CAI is kind of the leader of reserve study standards. So that's another thing to consider to make sure that the reserve specialist is going to create the reserve study in accordance with the standards.
Awesome. Okay, great. I think we are good to go. Thank you so much, Michelle. We'll certainly circle back with you after Jessica's for some wrap up and any discussion that comes from Jessica's presentation. Thank you so much. Jessica, take it away.
Hi, everyone. Thanks for joining. We had over, I think, 130 attendees. So thank you so much for devoting an hour of your time tonight for Michelle and Kat and I. So we are going to talk about bank financing for capital projects. So if you've done your reserve study and you see that there's a deficit in your funding and you have projects that you're not going to have internal funds to pay for, one of your options is bank financing. I'd like to start out, what is a condominium loan? I'm sure, a lot of you have done these before. Some of you may not have. So I'd just like to give a quick overview. And a condominium loan is lending money to a condominium in exchange for pledging the community's income. So with these loans, it's unsecured debt, which means there's no real estate as collateral. So if you go purchase a single home, right, the collateral for that mortgage is the house if there is a default on that mortgage. With condominium loans, we don't have that. So basically what happens for the collateral is it's secured by a UCC filing, which is a Uniform Commercial Code filing. And it's just evidenced by either a unit owner vote or a board vote, whatever your documents provide, approving the loan as required by your documents. The one question I always get when I sit down with boards that they're very hesitant because they think it's going to affect their personal credit. And just like when you sign for other contracts with other vendors, you're signing on behalf of the association. So for these loans, you are just signing on behalf of the association. They do not affect your personal credit at all. These are not a mortgage. I look at them more like a business loan. So basically for these condominium loans, we are using the association's balance sheet to determine credit quality. So like if you were going to apply for a mortgage for a single family home, or when you're going to apply for a mortgage for your condominium unit, they're using your personal balance sheet to determine the credit quality. So you're looking at income coming in and expenses going out. So we're doing the exact same thing for the association loans, just using your balance sheet. So why communities borrow? So there's many reasons. The main reason that community associations borrow is for capital projects, the ones that are identified in these reserve studies that Michelle was talking about. And also, one of the other areas I see a lot are the unexpected repair projects. And I use premature pipe failure or the riser projects as my example, because just like just like in life, you can plan for as much as you can, but there are always surprises. And those surprises, if they're deemed capital improvement projects, we can be financed. We do some financing for energy upgrades with cost savings, some for augment reserve funds. We do some unit purchase by the association. If the association is purchasing a unit, sometimes they do that for common space, common elements, or sometimes they're purchasing a super unit for their super to live in. And then we also see if you already have a debt that you're going to refinance existing debt, and you're going to then add additional loan proceeds for other projects. So things to consider prior to borrowing. I think the most important thing, so whenever I start talking to boards, the first question I ask is, does your attorney know that you are thinking about borrowing money? And a lot of times the attorneys aren't brought in early enough because they are the ones that are going to be able, it is money well spent to have them review your governing documents to let you know what authority you have to borrow money. You know, sometimes it's just a board vote. Sometimes it's a membership vote. Sometimes there's a percentage attached to that membership vote. And in usually in some of the newer communities, it's well laid out and documented, but sometimes it could be included in the declaration, it could be in the bylaws and the articles. So I really, really suggest to bring in your attorney early, let them review your documents, because you don't want to get to the closing finish line and then find out that you don't have the authority to borrow and you have to go and start the process again. So that's probably one of the most important pieces of this, is bring the attorneys in early. I also think when you're starting to consider to borrow is community buy-in, right? Like as a board, you understand what projects have to be done. You're using your reserve studies as a guide, but the community needs to have that information. And I think the more transparency that you have with your community members and the more membership meetings and the more open meetings that you can have with them, for them to be able to educate them for what is needed for the community and why, right? And I think you'll start to get that community buy-in for some of these bigger projects. I always say, like, you're not gonna have a project that you want to finance and you're gonna have 100% of your membership on board and ready to go. You're always gonna have a contingency of negativity, and that negativity will start to shrink with the more information that they are provided and the more they understand about the project. So bring in the community. They want to understand, they want to have a say, and that community, you'll get that community buy-in that you're looking for. Ask the question, like, how do you access the money, right? A lot of times these loans will close and no one's really asked that question. You know, how do I get my money after this loan closes? Is there a draw? Is it funded to my reserve account? So that's one really important question. The next is your prepayment penalties. If you want to be able, let's say you're taking out a 10-year loan and you want to be able to pay it off at year 7, is there a penalty? With a lot of these loans, you should be able to prepay them without penalty as long as you're using association funds. If you go to refinance with another lender, there's going to be a penalty. But if you are using association funds, you should be able to prepay these without penalty. And again, consult your professionals. Bring in your legal, your engineer, your management company, your CPA. They all have very valuable information and knowledge when it comes to bank lending. So bring them in early. It'll be money well spent. I like to talk about kind of the benefits of a loan versus assessment, because the loan is just one option, right? If you have a deficit and you have a project to do, you have your assessment option as well, like a short-term assessment to collect the money to do the project. But if you choose the loan, the benefits of that is there's no immediate impact on owner equity. And what I mean by that is if you're doing a loan, you can amortize it over, let's say, 120 months instead of trying to collect this assessment within a 6-month, 3-month period or a 6-month period, right? So your residents can participate in the loan and pay that back over a longer term, and they don't have to go and take a hit and take cash out of their savings or their 401k or borrow from an insurance policy. They're able just to make their monthly payments. And you're able to finance 100% of the project costs. So maybe instead of doing, 3 buildings each year, you're going to do all 15 buildings at one time and be able to save on, you'll be able to save on material costs because you're buying your material all at once. You don't have to worry about changes in, let's say, shingle colors if you're doing it over, a 5-year period. You're able to mobilize your contractors once. You're able to have your engineers on site once. We talked about being amortized over a longer period of time, and amortized just means that you're spreading those payments over, let's just use the example of 10 years, 120 months. It doesn't impact your current reserve balances. So if you want to borrow for one project and then you're going to save your reserves for the next project and keep contributing to that reserve account. So when you get to, let's say, your roofs, you have the full reserve fund to pay for your roofs. Monthly payments for delinquent accounts are immediately picked up by new owners. So if someone is selling their unit, that loan payment can continue on to the next owner, or it can be negotiated at settlement. Both happen. So key loan criteria. So using your balance sheet and your financials to determine your credit quality, this is what we're looking at. We're looking at your delinquency ratios. Are the residents paying their current fees right now? And we expect, no one has 100% people that are paying a lot of the time. So a lot of times you have a handful of people that are either late payers, or sometimes there's a foreclosure or bankruptcy. But we like to keep the delinquency ratio under 10% of the units. We also look at owner occupancy. How many of the units there are owned and how many are rented? We look at maintenance fee comparison versus neighborhood. So what I like to say is we look at, where your fees are now and where they would need to go in order to cover the debt service, what that percentage of increase is. And really, we just want to make sure that you're not pricing yourselves out of your neighborhood, right? We want to make sure that real estate agents still want to bring potential buyers into your community, right? We don't want that to scare them off. And, I always say, if you're thinking about a loan and you end up doing it, like, bring in the real estate agents that focus in your building, right? Give them the knowledge of the project and what you estimate those values to be, like, once the completed. If you're doing, I'll use an example, like if you're doing all new roofs and all new siding, the values of those units are going to increase. And you can empower those real estate agents with that knowledge as they're, bringing in potential buyers. We look at the age of the community. Is it an older community? Is it a newer community? If it's an older, really looking at their reserve study to determine, what else is coming up within that loan term they're going to have to take care of. We talked about the size of the maintenance increase. We look at loan to value, right? Does it make sense with the project that you're doing compared to the values in the community? And most important, and this ties back to Michelle's presentation, we look at the reserve requirements over the term of the loan. So if you're doing, you're going to do a roof and you're taking out a loan for your roof replacement and you're going to do a 10-year loan, what else is coming up during that 10 years in that reserve study that you're going to have to self-fund at that point? So we will actually take your reserve study for underwriting and we'll spread the reserve study just to make sure. And it's not just like Michelle said, the reserve study is a guide. So we just want to make sure that within that 10-year period, you're going to be able to self-fund the other projects that are coming up because you're getting to your reserve account. We look at professionally managed versus self-managed. We look at the review of the project plan, people, and process. Do you have the right people in place to do this large scale project? Have you brought in your engineers, right? Have you brought in your attorneys? We look at the historical financial performance. So during underwriting, we'll ask for 3 years of financials and we'll take a look at them. Really, we're just looking for trends, right? We're saying, okay, in 2023, they had a surplus. In 2024, they had a small deficit, but they made up that deficit in 2025 by increasing their operating budget. So we're just looking for any trends that we can see. We want to make sure what the underwriters are really making sure is that your operating budgets are substantial enough to cover your operating expenses. So you don't really need an increase in your operating budgets too. We're looking to see if the community is maintained. And then we're looking just at the strength of the management staff. We will, like, as I said before, professionally managed. So some loan related questions I have up there, some pros and cons. So some pros of doing a loan is you're going to avoid the large lump sum payments, right? If you were doing a one-time special assessment, then you'd have large payments that somebody would have to come up with a hit to their own equity. More affordable payment options. Cons to a loan, you are going to pay interest, right? You are paying for that. You'll be paying principal back, but you'll also be paying interest. And then consider the impact on the monthly dues. So you can repay these loans in a couple ways. They can be, your debt service can be included in your operating budget. You would just have a line for your debt service, or you can do a loan assessment in addition to your regular condo dues. And really what most communities do is if you're going to do a 10-year loan, they would have their assessment or their loan payments match that term, that amortization. So it would be for 10 years. Resale impact, there really isn't one, right? For these loans, because there's no real estate tied to them, there's no lien on your units at all. So you can buy and sell as you currently do. If you have a loan or a special assessment, it'll be in your resale disclosure package. If the loan payment is built into your general assessment, there's no impact at resale. But if it is built in as a loan payment or a special assessment, you would have to put that in there. And then impact on values. I mean, I think when you're doing these projects, what is the impact on the value of your home? We talked about the prepayment ability, and then delinquent payments. So we get that question a lot. What happens if somebody can't pay, right? So if somebody can't pay their portion, then you do have to pull that remaining payment from either your operating budget, your reserves, or go back out and reissue a special assessment. So it has to be made up somewhere because your payments won't change to the bank on a monthly basis. There's two types of loan products that are pretty standard in the industry. The first is a term loan where your interest rate is set for a specific number of years. I would say most often terms up to 10 years are chosen to give everybody a little breathing room. These are fully amortizing loans, which just means when you make your last payment, it's paid off. There's no balloon at the end of the term. Principal and interest are due. And we talked about your prepayments should always be permitted without penalty as long as you're paying with internal funds. The next loan product is what I call a draw to term or multiple disbursement. You'll have an interest only period, typically 12 months. I think it's pretty typical for most of these projects. You'll have a 12-month interest only period that then will convert to your amortization after the maturity of that draw period. So during that draw period, you are paying interest only. And then when it matures, it converts back to your amortization and you pay principal and interest. And I always say, I always will give two options. If you choose the draw to term, you have to just remember that, yes, you're paying interest only during that draw period, but when it converts and it starts to amortize, you pay interest and principal. So you essentially pay interest when you draw it down, and then you pay interest when it starts to amortize. And I always, when I talk to boards, and if you have any questions, I'm happy to kind of walk you through the products and what I think best fits the projects that you guys have in front of you. Loan pricing. This is just sample pricing I put in here, but the treasury bond yield is what our benchmark is. So if you were doing a 10-year loan, the 10-year treasury would be the benchmark plus the bank spread. So I think the 10-year treasury, I think today was at like 4.12% plus a spread of 2.5 would give you an all-in rate of about 6.62%. And the spreads will vary depending on loan size and credit quality. And I just wanted to end, I thought it's always interesting to do a case study. So this was the original request with this. They were requesting $750,000 to fund a roof replacement project. They wanted a 12-month draw, and then they wanted it to convert to a 7-year amortization. Debt service repayment was going to be built into their budget. So they weren't going to do any special assessment. They were just going to increase their operating budget in order to cover the debt service. And their residents wanted the ability to prepay prior to loan closing, which a lot of times we'll start looking at a loan and I'll talk to the boards and they want to be able to give their residents options, right? And they have, some people want to participate in the loan. Some people want to pay their portion of the loan before it closes without interest. So those are really your two options with the ability to prepay prior to loan closing. So we ended up, even though they wanted $750,000, the final loan amount was $495,000 because they collected $255,000 in prepayments from their residents that wanted to prepay their portion before the loan closed because they did not want to pay interest. So they prepaid their portion and then the rest of the residents participated in the loan, which brought the loan to $495,000. We decided to remove the draw period because they were doing a roof project. So they had a contract in place, they had a contingency built in, and they knew that they were going to spend that whole $750,000. So it made sense for them just to start paying it back on day one instead of doing a draw period with interest only. So it was a fully funded loan. We funded it directly to their reserve account without any restrictions, and they were able to pay their contractors. And then they ended up, for the people that did participate in the loan, they did a special assessment for 7 years to match the amortization of the loan. And that is all I have today for the presentation. Thank you very much. I'm happy to take any questions.
Okay, great. Thank you so much. We had a question early on, just looking for confirmation that co-op associations are also candidates for these types of loans in addition to HOAs and condos.
Yeah, so co-ops, because they actually, it's, the building is real estate, they have underlying mortgages. So that's a different type of loan product. Unless they were looking for a small loan where they didn't want to do an underlying mortgage, then we could do a condo style loan like this. But typically with co-ops, you're pledging your building, you're pledging your income. So there is an actual mortgage on that.
Okay, great. And I think we actually just had a follow-up question on that question from one of our co-op shareholders saying, so if some owners prepay and others participate in the loan, what does that mean if the association is a co-op in which the owners are shareholders? It sounds like what you're saying is that the arrangement is a little bit different for those types of loans.
Yeah, it's a completely different product, the co-op mortgages. Yeah, the prepayments, I was just referring to the condo loans.
Sure.
And the HOA loans, but for the mortgages, that's a different product. Yeah.
Okay, great. Awesome. So I think what we're going to do is we're going to bring Michelle back in too. And Jessica, if you could stop sharing your screen, I'll start sharing mine just as a little placeholder. Okay, great. So we have a couple more questions. Looks like, can you explain whether it would be possible for an individual unit owner to pay off the remainder of their loan midstream to avoid future interest? So I think what they're saying is if they initially didn't go for the, the upfront payment, and halfway through, they decide to kind of pay off, does that affect how much is still due? Or is that kind of up to the association?
Yeah, and that's a great question. And that is really totally up to the association, to the board member at that time. So I always say when you were talking about allowing prepayments, to make it as simple as possible, right? Because the more choices that you give, the more complicated it gets, because your management company is the one behind the scenes that is actually, keeping track of all of the interest that's due. But if they want to prepay at year 4, or at year 5, or at year 6, the bank doesn't do that because of liability. So it gets really complicated, the number of choices that you give. So I always say, keep it simple, right? You either, prepay before the loan closes, or you participate in the loan. And then if you sell your unit, you can obviously negotiate it off at that point. But that is completely up to you guys, what options you want to provide. I just think that the more options that you give, the more complicated it becomes to the back office.
Sure, absolutely. We have one more question. Are lines of credit like HOLOC for homeowners available for condo buildings to have in place for emergencies?
Not typically, right? Because there is no real estate, so they don't have any collateral, so it's unsecured. And to budget for those like revolving lines of credit, the way that you approve the budgets on an annual basis doesn't really like aid to that as being a product. So typically you would have to do like a draw that then would convert to your amortization.
Got it. Okay, great. I know we had a couple others that actually I thought of along the way. One of them was, can a loan be included in a reserve study?
Yes, and I'll let Michelle answer that.
Thanks. And that's a great question, and it absolutely can. So some associations prefer to keep it outside of the reserve study to handle differently, but we certainly can show it on the reserve study. So we can show the project expense, we can show the expense of the actual contributions, what they need to offset, and then show that on the funding strategy as well. So it would look like kind of money in, money out in that case, but then you have it holistically included everything in kind of community roadmap.
Okay, great. Awesome. One question also, does the association have to follow the reserve study recommendations?
Don't, not at least in DC and in Virginia. So in Virginia, you're required to do a reserve study, conduct one every 5 years. You do not have to follow it. In Maryland, you're required to conduct the reserve study and you're required to follow the funding recommendations. In DC, you are not required to conduct them by law. It's my understanding that could come in to be, especially since Virginia and Maryland require them. However, it's not a requirement now. And then you do not have to follow the funding recommendation. It is a best practice, but not a requirement.
Okay, cool. And Jessica, how can associations plan ahead to increase their chances of securing funding? What kind of planning
Sure.
and proactive?
Yeah, I think, I mean, as soon as you notice there's a deficit and you think that maybe a loan would be an option for you, I think having those conversations early, like I'm always here, you can call me, you can send me your financials, I can review them and say, okay, this is where I think your credit quality is at this point, and this is where you need to be in order to pre-qualify for me to be able to issue you a proposal, right? So bring in your professionals early, not just your banker, your attorney, your engineers, like really start the due diligence for that project. Pay close attention to your delinquencies, right? Is everybody paying? Do you have any problems? If you do, make sure that they're following up with collection efforts. And again, just because you have maybe one unit could have a foreclosure, you have somebody that's a slow payer, maybe you have a bankruptcy, that doesn't automatically eliminate you. We see that all the time. As long it depends on what that percentage of delinquent units is in your community. So don't get nervous about that or scared by that. We can always talk through that. And a lot of times there's a story to be told, right? A lot of times I can look at delinquency reports and their dollar amount of delinquency compared to their annual budget is over guideline. But that's because maybe they had, one foreclosure on there, and maybe it had, I mean, foreclosures take a long time, right? Maybe it had been sitting on there for 5 years, and in 5 years it accumulated a lot of debt, a lot of unpaid assessments. So there's a story to be told there. That makes sense that it's a concentration of ownership of that one person. So just, I think the answer is bring in your professionals early, let everybody evaluate the project, the scope, the financials, because you'll be in a better spot when you're ready to execute.
Sure, sure. Planning is everything, right? Well, one thing I think questions for you both is, when it comes to communicating the importance of reserve studies, of proactively preparing to be a good candidate for funding, of approving some kind of loan or special assessment, what's a good way to communicate that to the homeowners?
I think, I mean, I would say transparency, like just be honest with what is going on, what you see, and what you believe your options are. And the more information you have that you can give the residents, I think we talked about community buy-in, right? If they understand what that reserve study is showing and they understand what those capital projects are going to take to be funded, then I think that that community buy-in, that transparency will help foster a positive environment for everybody.
Totally agree. And let us help, right? Bring the professionals in. We're more than happy to have the conversation and help create that alignment. We're independent, third-party opinion, and happy to have that conversation with the owners as well. I think there's sometimes this fear that if you do a reserve study, now it's exposed and there's a liability, you have to follow it. And that's not the case. It really, if your strategy is to not run reserves, you have to have another strategy, right? So what is that strategy? Get the study done, understand your needs, and maybe your strategy is to take out a loan or conduct a special assessment, but at least inform the homeowners, have that transparent conversation about the needs of the building and that the money is going to need to come from somewhere so everyone can start personally planning, if not through their dues.
Right. Sounds good. Yeah, it sounds like there are some really great resources out there from CPAs and lenders and reserve advisors to really help everyone feel like they don't have to do it alone or don't have to become an expert from the start. I think board members a lot of times feel like they have to be an expert on everything. And so it's kind of nice having someone who can step in with 15 or more years experience to help out. Well, I think that's all the questions we've got right now. We're right on time. It's 7:03 p.m. As I mentioned, we will be circulating. We'll send out a link. We'll also be posting a link to the webinar on YouTube. But certainly if you're interested in following up with either Jessica or Michelle to schedule some kind of a meeting or discussion with your board, their contact information will be available as well. So thank you so much, Jessica. Thank you so much, Michelle. I think this has been a really good opportunity to get a lot of good information in about an hour. And hopefully, board members, this has been good for you too. You guys are volunteers. Every minute that you spend on your communities should really pay off. And we certainly, in the property management industry, appreciate everything that you do and all that you do to put in making your communities the best they can be. So thank you guys, everybody, and have a great week.
Thank you.
Everyone, appreciate your time.
Take care, guys.